Imagine you had $10,000 sitting in a bank account 20 years ago. If you had walked into a store and bought physical gold with all of it, or if you had used it as a down payment to buy a piece of American land, which choice would have made you richer today? It is the ultimate financial showdown that has divided investors for centuries, the shiny, unyielding metal against the physical dirt beneath our feet. Both are real, tangible assets that you can touch. Both are famous for protecting your wealth when the stock market goes into a free fall and inflation destroys the dollar. But behind the hype, the data tells a completely different story. One of these investments can quietly build you a massive fortune through leverage and passive income, while the other relies entirely on global fear and economic chaos to pump its numbers. In this video, we are putting emotion aside. We are going to look strictly at historical U.S. market data, inflation metrics, and tax advantages to answer once and for all, gold versus land. Where should you actually put your hard-earned money? Let's find out. Let's start with the oldest form of money known to humanity, gold. For thousands of years, whenever empires fell or currencies collapsed, gold survived. But how does it perform as a modern investment in the United States? To understand gold, you have to realize that it is a defensive asset. Over the last 50 years, gold has delivered an average annual return of roughly 8%. That sounds great on paper, but there is a catch. Gold does not grow, it does not produce anything, and it does not pay you dividends. A bar of gold sitting in a safe today will still be the exact same bar of gold 20 years from now. So why do people buy it? The answer is liquidity and crisis control. Gold is incredibly liquid. If you need cash tomorrow, you can sell your gold anywhere in the world within minutes. More importantly, it is the ultimate hedge against inflation. When the Federal Reserve prints trillions of dollars and the purchasing power of the US dollar shrinks, gold historically shoots up. For example, during times of massive geopolitical tension or economic high inflation, gold prices often reach record highs because big institutional investors use it as a safe haven. It is a financial insurance policy that protects your capital when everything else is burning down. Now, let's flip the coin and look at land. Legendary American writer Mark Twain famously said, "Buy land, they're not making it anymore." And he was absolutely right. Land possesses something that gold can never replicate: absolute physical scarcity and high utility. You cannot build a house, grow food, or run a business on a bar of gold, but you can do all of that on land. Historically, U.S. residential and raw land investments have appreciated at a steady rate, often pacing smoothly ahead of inflation. But the real magic of land investment boils down to two words: leverage and cash flow. Unlike gold, where you have to pay the full price up front, land allows you to use bank money. You can put down 20% of your own cash, borrow the remaining 80%, and own the entire asset. As the land grows in value, your return is calculated on the total value of the property, not just the small amount you paid out of pocket. Furthermore, if you develop that land or rent it out to farmers, solar companies, or builders, it generates monthly passive cash flow. It becomes a wealth-generating machine that pays you while you sleep. However, neither of these investments is perfect, and both come with hidden traps that can catch beginner investors off guard. Let's look at the downsides. Gold might be safe, but it can be incredibly volatile for long stretches of time. In fact, after hitting a high in 1980, the price of gold entered a massive slump and took nearly 26 years just to get back to that same price level. If you invested during that period, your money effectively did nothing for a quarter of a century. Plus, physically storing gold safely requires paying for secure vaults or insurance, meaning it actually costs you money just to hold it. Land, on the other hand, has a massive entry barrier. It requires significant capital to buy, and it is highly illiquid. You cannot sell a plot of land in 5 minutes if you have an emergency. It can take months, sometimes even years, to find the right buyer at the right price. On top of that, land comes with ongoing expenses. Even if it is just raw dirt, you are legally obligated to pay annual U.S. property taxes. If you don't manage your cash reserves properly, those taxes and maintenance costs can drain your bank account before the land appreciates enough to turn a profit. So, when we look at the historical U.S. market data, which one is the truly better investment? The answer depends entirely on what phase of your financial journey you are currently in. If your primary goal right now is wealth preservation, meaning you already have money and you just want a safe place to hide it from inflation and stock market crashes, then gold is your best friend. It is simple, liquid, and safe. But if your goal is wealth creation, if you want to build a real estate empire, use leverage to compound your money, and generate consistent passive income that can fund your retirement, then land wins by a landslide. Land gives you tax write-offs, bank leverage, and development opportunities that a stagnant piece of metal simply cannot match. For a winning portfolio, many wealthy investors choose a mix: 80% land and real estate for aggressive growth, and a small 5 to 10% allocation in gold as emergency insurance. What about you? Are you teaming up with Team Gold or Team Land for your future? Drop your thoughts in the comments below. Don't forget to hit that like button, subscribe to the channel for more straight-to-the-point finance breakdowns, and we will see you in the next video.